So it finally happened. The Federal Reserve just lowered rates by a quarter of a point, which sounds small, but has consequences for your credit cards, your mortgage loans, your car loans, your student debt, even your savings account. Now, some of these effects are actually good, and some of them, well, not so much. Let's start with the debt that most of us feel every single day, and that's credit cards. You see, most cards have variable rates tied to the prime rate. When the Fed lowers rates, that prime rate follows, which simply means that your APR will likely be lower now too. Let's say you owe $5,000 at 20% APR. This cut might drop you down to 19.5%, which means that you'll save around $25 per year, maybe $2 per month. So, in short, credit card APRs remain pretty much a financial emergency for a lot of people, but they will get somewhat lower. Now, mortgages. Most people think, right, that the Fed cut equals a mortgage cut, which is wrong. Mortgage rates are actually tied more to treasury yields and investor expectations than the Fed cut. And that's why rates are already drifting down from their 7% peaks earlier this year. And currently, we're somewhere close to 6% for a 30-year fixed rate loan. But why is that? Well, that's because the Fed cut was already priced in. You see, last week, US mortgage rates posted their biggest weekly drop in 12 months. And that was before the Fed cut was even announced. And US mortgage demand, well, that just surged 30% over last week as Fed rate cuts began. Oh, and those refinance applications, well, they jumped almost 60% in 1 week to levels not seen since the 2020 pandemic. And more cuts are actually expected through 2025 and into 2026. So if the Fed keeps cutting, mortgage rates might drop to 5.5% or even 5% by next year. So let's do the math on a $400,000 loan. At 6%, that's around a $2,400 monthly payment. At 5.5%, you're looking at $2,270 for your monthly payment. And that difference there is around $160 per month, which is around $1,900 or more per year. So if you're thinking about refinancing or buying, you have to weigh the costs of doing it now versus waiting for potentially lower rates. But you can't forget, right, that refinancing costs are about $3,000 to $5,000 in fees. If rates drop another 0.5% or so, you might save $160 per month, which will take you about 2 years to pay off those refinancing costs. And unfortunately, nobody knows if rates will actually drop that much. In my opinion, the best time to buy real estate is not always now or later. It's anytime the numbers make sense. And what about cars and auto loans? Well, car loans get a bit weird here. You see, auto loan rates are fixed once you sign. So if you already have a car loan, nothing really changes. But if you're shopping for a car or looking to refinance your car loan, you might see slightly lower rates on new loans. The current average interest rate for a 5-year new car loan is around 5.5%. After a few more Fed cuts, that might drop to 4.5% or even lower. And on a $30,000 car loan at 5.5%, you're looking at around $1,150 for your monthly payment. At 4.5%, you're looking at around $1,120 for your monthly payment, with that difference being around $30 per month. Now, something you need to know is that car dealers and manufacturers use these rate cuts as marketing opportunities. Rates are dropping. Special financing event. Buy right now, even though you're only saving maybe $10 to $30 per month. So you want to avoid the expensive mistake of buying a car you weren't planning on buying because financing got slightly cheaper. A better way to decide is to consider your transportation needs, not your financing costs. If you were already planning to buy, a small rate drop is simply a nice bonus. If you weren't planning to buy, Don't let a tiny rate change push you into a major purchase. Myself, I wouldn't fall for it. And on the topic of student loans, what happens with them depends on which type of student loans you have. You see, most student loans are federal loans with fixed rates, and the Fed rate cuts really don't change them. But private student loans are actually different. Some of you have variable rates tied to benchmarks that move with Fed rates. If you have a variable private student loan, your rate might drop a quarter% automatically. Now, on 50,000 Now, on a $50,000 private student loan at 6%, your new rate might be 5.75%, meaning your monthly payment drops from $555 to $545, and you save $10 per month or $120 per year. Now, some people with federal loans may consider refinancing to private loans to get lower rates. But federal loans have protections like income driven repayment plans, forbearance options, and forgiveness programs. Private loans usually have lower rates but fewer protections. Here's an example: you have $40,000 in federal loans at 6.5%. A private lender might offer you 5%. So you'll save about $50 per month or $600 per year by going with the private lender. But you lose income driven payments if you lose your job or potential loan forgiveness and flexible deferment options. So if you have stable income and plan to pay off your loans normally, refinancing might save you money. If you work in public service, though, and you're eligible for loan forgiveness or have income uncertainty, you might want to keep the federal loan protection. Now let's move over to your savings account. You see, rate cuts are good for borrowers and not so good for savers. When the Fed cuts rates, banks pay you less on your savings, and that's always. In fact, I'm already getting notices from my banks and brokerages letting me know that my APY has decreased. So, savings accounts, CDs, money markets, their yields rise and fall with the Fed. And right now, top high yield savings accounts and 1 year CDs are paying around 4% or more, which is far better than inflation. But those yields are on borrowed time because high yield savings accounts paying 4.5% today will probably drop to 4% within weeks, then 3.5% over the next few months. So on $10,000 in savings at 4.5%, you make around $450 per year with just interest. But at 3.5%, it drops to $350 per year in interest. So you lose about $100 annually there. Now bump that up to 50,000 and you lose $500 annually. Not devastating, but also not nothing either. You see, banks make money on the spread, right, between what they pay savers and what they charge borrowers. So if you're looking to save your money, consider locking in current rates before they drop even further. CDs let you lock in today's rate for 1 to 5 years. Current 1 year CD rates are around 4.5%. Current year 5 year CD rates are around 4%. Now I get it, right? I know you can't touch that money without penalties, but you're guaranteed that rate regardless of what the Fed does next. If you should take that bet or not really depends on your situation. If you have some cash you know you won't need to touch, locking in 4.5% for a year or more makes sense. If you might need the money, then you want to stay away from that, right? You want to remain liquid. Don't chase the highest rates without considering your actual needs. A better approach here is simply to match your saving strategy to your timeline and flexibility. So now that we know all of this, how do we actually use it to protect ourselves in our money making decision? Well, the first thing we must consider is that the Fed isn't trying to make us richer or poorer, right? They're trying to keep the economy stable. And rate cuts encourage borrowing and spending. Rate hikes encourage savings and a slowdown on the economy. Right now, they want economic activity. So your job isn't to predict what they'll do next because even economists, right, with PhDs get the Fed predictions wrong all the time. Your job is to understand what you can control. For debt, pay off high interest debt regardless of small rate changes. Credit card debt at 19% is still an emergency and not a manageable expense for Most people. For savings, don't panic about dropping rates, but consider locking in current rates if you won't need the money anytime soon. And for those major purchases, base decisions on your actual needs and financial situation and not on small changes in financing costs. Here's the truth: most people react to Fed decisions emotionally. Rates dropped, I should buy something. Rates dropped, my savings are doomed. Rates dropped, time to refinance everything. But once again, the better approach is to ask what actually changed in your specific situation. The Fed will keep doing Fed things. Sometimes they'll cut rates, sometimes they'll raise them. But a financial plan that works regardless of what they do, that's the only part you can control. And it's really the only part that really matters for your money. So let me know in the comments. Will you be taking advantage of the interest rate cuts immediately? Are you waiting for lower interest rates to make a move? What do you think about all of this? And if you like the video, go ahead, give it a like, a thumbs up, subscribe to the channel if you're not subscribed, and I'll see you in the next video. My name is Karan.